where does productivity come from? And what do we mean? What we mean is getting more GDP, in principle, for the hours that we work in the economy. But what we're really talking about is sort of setting up the economy with an environment that encourages businesses to then be able to innovate and invest and choose to innovate and invest. So when I talk to businesses and say, well, what is the thing that's actually constraining you from making that next investment decision or doing that next bit of innovation? And primarily the feedback is, I'm really finding it hard to get the workers that I need. We've got a tight labour market, and the regulatory environment I face is actually really quite complex.
Welcome to In the Black, a CPA Australia podcast. I'm Tahn Sharpe, editor of In the Black and host of today's podcast. Today we're speaking with Paul Bloxham, HSBC's lead economist for Australia, New Zealand and global commodities, who I hope will provide us with a relatively brief breakdown of what we can expect in economics across Australia and in the Asia-Pac region for 2026. Paul, thanks for joining us.
Great to be here.
Now, I've heard you speak at a number of events recently and over the years, and including a CPA Australia's recent Congress in the Gold Coast. So I'm confident that you'll be able to give us a good view on where the economy is heading next. And to kick off, I'll ask you, after several years marked by pandemic disruptions, we've had surging inflation, interest rate increases, and a lot of geopolitical upheaval that we'll get to later. Many might say that we've entered probably one of the most volatile periods in recent economic history. From your perspective, what phase is the Australian and perhaps the broader Asia-Pacific economy in now? And what do you think the next phase might entail?
So I think that's absolutely right, that what we're looking at is a global economy and a local economy that is now more subject to supply shocks. So this is the kind of how economists think about things. They think about things as related to demand, how much people are spending, how much businesses are spending, how much is demand driven in the economy,
Sure.
and how much is related to supply, how much is about the ability of the economy to meet that demand with supply. And if you think about the things you've just described, the pandemic was obviously an enormous negative supply shock because, well, we had a virus that constrained our activity and shut down borders and constrained people moving in various locations, and that was a big effect. Geopolitical effects can be big supply disruptions, and we'll get to some more of those a little bit later as well. And then I think for Australia, a big feature at the moment is that we have an economy that is quite supply constrained. Like, we would like to grow our economy a bit faster than we can at the moment, and that's what's actually shown through in recent times, that the economy picked up through 2025. Growth was a bit stronger than expected. It wasn't super strong, but it was a bit stronger than expected. But mostly what happened is the economy ran up against the ability of the economy to deliver, the supply side. We haven't been building enough housing. We haven't got enough cheap energy. Productivity is particularly weak in the Australian economy, and that has meant that just a small rise, a more modest rise in GDP growth last year of 2.6% in the end was enough to sort of re-inflame inflation. We got inflation picking up again, not because the economy's booming, but because it hit those supply constraints. So I think that's the way I would sort of think about what we're facing. And I guess your question is sort of framed around, we've seen more of these sorts of events recently. I think that's true. I think there was a period that the economists would describe as the great moderation that was going on through the early part of this century, the late 90s and the early part of the century, where primarily the big effects that drove cycles in the economy were about demand and how much consumers spent, and there were cycles that were demand related. And now we seem to be in an environment where there are more regular, frequent supply shocks, and one of them is geopolitics. The pandemic was another. Another is the climate change and the events that's delivering. And so there's just more of these more frequent these supply shocks going on. And so that I think is one way at least to frame and think about what's going on in the world at the moment, and for Australia too.
That is an interesting way to frame it, actually. And when you say that, I think of all those sort of the bottlenecks and the foundational flaws in things like housing supply and things like that really you contrast back to the 80s, as you said, when the issue was really the sort of the demand. So it's an interesting way to frame it up. But you touched then on inflation, and rising inflation has been the dominant economic narrative now for quite some time in Australia and the broader APAC region. And we saw that again with the RBA raising rates in February. Will that continue to be the case? Will we still be talking about rising inflation for years to come in Australia? until things happen, like spending pulls back and productivity increases, and we solve those kind of problems?
So this is great because the introductory question and the framework I've given you for thinking about the answer, the sort of demand and supply, actually helps you to explain how it is and why it is inflation's rising again in Australia, and why it's been a feature of the story for sort of seemingly quite a while. So I guess the way I think about this is when the pandemic came through and shut down the borders and shut down the economy, and obviously things sort of stalled for a period of time. In 2022, when we reopened our economy after the pandemic, we saw this surge in inflation. That was the big wave of inflation that we saw, and got to about 8% in Australia, which is a multi-decade high, really high rates of inflation. How did that come about? Well, we reopened the economy. We hadn't done all the things we'd wanted to do for 2 years because we told we couldn't do them. And so when we could, we all started to do them. We were cashed up because the government had given really large fiscal transfers to the households and businesses. We'd saved a lot of it, and we were all ready and G'd up to want to go and do these things. So go to restaurants, go traveling, go to the theatre, go to the sporting events, all those sorts of things you couldn't do for a couple of years. So demand surged in 2022, but it hit an economy that just wasn't ready to deliver. It didn't have the capacity to meet that demand. We'd shut the border for 2 years. We didn't have enough workers because they hadn't flowed in across the border. They weren't in the right places either. There were supply-related disruptions. So
was that the
us
genesis of the supply issue? It started there in the post-pandemic era, and now it's continued with all this geopolitical volatility?
Yeah, so I would describe it as that inflation surged because demand raced ahead of supply, and then what happened was the RBA responded to it because there weren't that many options, really. I mean, the only way to get inflation down at that point was to slow down demand. Fixing supply would take time. It takes quite a bit of time to adjust the supply side. So the RBA lifted interest rates by 425 basis points in 2022 and 2023 with the intention of slowing the economy down, and they did. The economy slowed in 23 and 24. And eventually, last year, the story for 25 was we finally got demand almost back in line with supply. Supply had sort of improved, and we'd reopened the border, we got the workers in the right places and so on, and demand had slowed down, and inflation started to come down. If you remember, in 2025, we got back down into the Reserve Bank's target band. We got down to 2.7 on the measure that they focus on by the middle of 2025. But then the RBA started to cut interest rates again. And so they cut 3 times, and that drove a modest pickup in growth, which we talked about a little earlier. But it didn't take long before actually inflation was showing up again. And that inflation was showing up because the supply side of our economy, the ability to meet demand, has been weaker than we thought. We haven't been able to build enough housing. We haven't had enough cheap energy available. And more fundamentally, we've just had a weak productivity performance. And so this is where we sit, and I think we can confound that with a lot of the global stories. There are a lot of other things going on. Of course, the developments in the Middle East right now that are forcing oil prices up. That's one. We've had the trade policy shocks that were coming through from the global economy last year, although they didn't really reverberate through to Australia that much. That was a pretty minor effect. There's lots of action in that supply on the story for the global picture, but actually the narrative I just told you about Australia is the primary story that's been driving domestic conditions. It's mostly a domestic story of inflation surged after the pandemic. We lifted interest rates to deal with it. We slowed the economy down, but we didn't quite get the gap between demand and supply completely closed. The RBA started lowering interest rates. The economy's been in an upswing, but it turns out the supply side of the economy is weaker than they thought. Productivity is weaker than they thought. And that's why we've ended up with this inflation challenge sort of reasserting itself.
Okay. Now, the RBA is, I would argue, becoming more sort of forthcoming with their thinking. I think Bullock's been pretty candid with her thoughts. But beyond central bank rhetoric, what indicators should people, and especially business leaders, be watching to understand where rates might go next?
Well, the main one to watch is inflation. I mean, that's, the RBA's primary mandate is to keep inflation between 2 to 3% in the medium term. And really what that means is they're trying to get inflation to 2.5. And as I've described, inflation came down a long way from 22 into 23 into 24. And by 25, on the measure that they track most closely, it's called the trimmed mean, which is a measure that strips out lots of the volatility in the CPI and is the one that they track most closely. It fell to 2.7. It got to as low as 2.7. So it didn't quite get to 2.5, but it got back to 2.7. Now, on the last 2 prints that we've seen, it's jumped back up to 3.4. So that's the main one to watch. But then if you want to work out where interest rates are going, what you're not just trying to track inflation, but what are the things that are going to drive inflation to slow down or speed up? And in terms of things that drive it to do that, you're looking at growth indicators. So if growth picks up, the economy's got more demand, then inflation tends to rise. So we look at things like GDP and business surveys and so on, consumer sentiment surveys, a whole collection of things. And then we can also look at things like the labour market, measures of the labour market, because if the labour market is tight, if the unemployment rate is low and inflation starts to rise, then obviously workers are going to feel they've got a bit more ability to sort of ask for more wage rises. And then that feeds into inflation too.
That also speaks to the supply factors that you're talking about, because when they start to turn, if they start to turn, there'll be a lag. So if you look at those factors first, you know that eventually it's going to come. Right.
So we've got some good models in economics that tell us roughly what the lag structure looks like. If we get a pickup in business sentiment, say, or consumer sentiment, consumers start to spend a bit more, businesses start to spend a bit more. That's sort of the first thing that happens. And then what happens is businesses decide that if they've got a bit more demand, they have to meet it by doing a bit more hiring. Mm-hmm. So what tends to happen is the labour market indicators tend to be the last thing that turns. In fact, the last thing that turns in any sort of sequence is usually the wage indicators, because you get a pickup in the economy. You start to hire a few more people, the labour market starts to get tight, those workers seem to then start to demand a bit more wages because they can. And so there's a lag structure in this. So if you're looking for the most timely indicators, the ones that really give you the sort of what's happening right at the cutting edge, you're looking for indicators of activity, if the activity is slowing down or speeding up. Now, the challenge is, from an economist's perspective at least, we've got lots of indicators that tell us something about demand.
Yes.
But we don't have very much at all, that tells us about supply. We just don't, we don't really know, we don't have a lot of indicators for that. So this is where inflation targeting itself is sort of clever in a way, because when you know that demand is picking up ahead of supply when inflation's starting to rise. And when inflation's starting to fall, you know that demand, you've got spare capacity in the economy. So that's why I started with inflation, and the inflation indicators are the first thing you watch, because they're the primary thing that you're trying to keep track of for both understanding how the economy is traveling relative to its capacity, but also understanding what the RBA is likely to do next.
Okay. I want to take you back to the geopolitical uncertainty that you mentioned earlier. It seems to be becoming the norm rather than the exception at the moment. Broadly, Paul, what do you think that means for Australia and the Asia-Pac region? Because, at the moment, peace is fragile, AI is very disruptive, and the trade guardrails are just being kind of ripped apart at the moment. Is Australia relatively inured from that, or are we just in the firing line as much as anyone else?
We are part of the global economy, and actually one of the things I say regularly to people to clients and when I do presentations is you've got to try and keep track of what's going on in the global economy, because most of the shocks that hit the Australian economy and either force us into a downturn or into an upswing come from abroad. They're mostly from abroad. Now, most of the domestic story of late hasn't been the big driving force, and that actually reflects that the global economy has held up pretty well. Despite all the things you're describing, despite the big changes in trade policy that we saw through last year, despite the geopolitical shocks that have been sort of so vivid over the past little while in terms of watching what's going on, so far, actually, global growth has held up pretty well. The global economy last year grew by about 2.8%, which is, for listeners, it's not a really strong rate. It's not a really weak rate.
But remarkably
it's remarkably well, held up remarkably well. Global trade continued to hold up. Exactly. No major economy went into a downturn last year.
Usually markets react to those kind of risks.
Right. So you then have to explain that, I think. And I think there are two things. The two fundamental things that I sort of talk about are, one, that despite all of the shifts and changes that happened in trade policy, countries were remarkably good at adjusting to it. In particular, China was very good at adjusting. A lot of the exports that it would otherwise have sold to the US that it didn't, it ended up selling into other markets. And last year, in 25, the primary driver of, China's growth was exports. Despite the fact that there was all this trade tension going. So that's one, reason why actually global growth held up. And the second reason, as I see it at least, is AI. The AI story has just proven to be bigger, more resilient, more infrastructure oriented, and just a bigger force in terms of driving global growth. I mean, last year in the US, they invested about $500 billion in AI infrastructure. This is data centers and electrification and energy storage and so on. And so that contributed about half of US GDP growth last year. I mean, about half of US GDP growth was driven by the infrastructure component related to the AI story.
And that's just an injection of efficiency.
Well, so no, it's just building stuff, right? I mean, that aspect is just building stuff. And then your point, which I guess is the next level of this, is the productivity that you might get off the back of adopting AI is being reflected in equity markets that are buoyant, and stock prices that are high, and so on. This is where you're seeing that reflected. But that combination has left you sort of with risk assets that are fairly buoyant, as well as an infrastructure build out that's been supporting US growth. But it's been flowing over borders as well because, well, these are global multinationals that people invest in. So it's a wealth effect for the global economy. And the US is, of course, if they're building lots of infrastructure, a lot of the components that go into it come from elsewhere. So you buy semiconductors and hard drives from Asia. So Singapore, Korea, Malaysia, Taiwan, these countries have done better in terms of trade than you might have expected, given the trade shock that was faced last year. So I think that's a lot of the reason why we've actually held up pretty well. And so you start off with the global economy, at least for the moment as we track, where actually despite the sorts of disruption that we've seen and the big headlines on trade policy and all sorts, the global economy has actually held up pretty well. Growth has held up pretty well. So you come back to Australia and say, well, if the global economy held up pretty well, it didn't deliver a big negative shock last year. It didn't deliver a big positive shock last year. And we circle back to the primary thing that's actually been driving Australia's economy of late has been domestic dynamics, is the domestic story. Now, that's not to say that there aren't risks. There are risks out there. The AI story itself may present risks. An reassessment of how much it's going to boost productivity would be a risk globally. We've got geopolitical risks playing out. We've got trade policy, which is still something to watch carefully. These are all the sorts of things that the world could deliver. So far, so good is the answer. The global story has not delivered a big negative shock in the form of that disruption we saw through last year.
What if we went a little bit more micro and we looked at businesses, especially domestic businesses that do trade overseas and work with overseas counterparts? What do you think will set apart the businesses that navigate these disruptions successfully from those that struggle to get through?
Well, it's a great question. I talk to businesses all the time. I mean, this is a part of the job that I do. I think a few things, one of the things that, to your point, I mean, the main thing is being nimble, is being able to adjust, is being able to find the new opportunities and make change when you need to make sure you can harness those opportunities. I guess the thing that really strikes me, and we talked about this a little earlier, is Australia has had quite weak productivity growth of late. In fact, weaker than we've had in the past, weaker than most countries are having. Other countries are having productivity challenges too, but ours look a little bit even on the weaker side than most of the developed world. And so, where does productivity come from? And what do we mean? What we mean is getting more output for the inputs we put in. It's that straightforward. Getting more GDP, in principle, for the hours that we work in the economy. And how do you get that to happen? Well, we talk a lot about what policymakers should do to lift productivity. And that's because we want policymakers to take action that makes our economy more efficient, that makes our tax system more efficient, that increases competition, that streamlines the regulatory environment, all these sorts of things. But what we're really talking about is sort of setting up the economy with an environment that encourages businesses to then be able to innovate and invest and be willing to and choose to innovate and invest. So when I talk to businesses and say, well, what is the thing that's actually constraining you from making that next investment decision or, doing that next bit of innovation? And primarily the feedback is I'm really finding it hard to get the workers that I need. So that's one of the pieces of feedback. We've got a tight labour market. It's difficult to get the workers that I need, and the regulatory environment I face is actually really quite complex. And so these two factors sort of mean that I don't quite get over that hurdle for making that investment decision. And so, to me, that's what policymakers need to focus on: sort of fixing those primary problems: deregulation, tax reform, competition. These are the things we need to see happen. So then the question, I guess, is there action happening in that regard? And there is. I think policymakers are aware. I think this productivity challenge has now become much, much more prominent and is something that policymakers at a state and a federal level are actively looking at ways to try to improve.
Yes.
And then in terms of what businesses are doing, I think, businesses are actually starting to look, the wheels are turning in terms of the investment and the innovation story. And we're seeing that, one, in this AI story. It's been slow, But I think there's more and more conversations that I'm having with firms about, well, adopting AI is going to be one of the pathways potentially to lifting productivity and improving and effectively lowering the cost base and improving the bottom line to allow that business to operate more efficiently and more effectively and be more profitable and take advantage of more opportunities. That's what we mean by lifting productivity.
Okay. And so for the businesses themselves, it's really being aware of those changes that are coming from policymakers and regulators, and being aware of when the sort of the regulatory guardrails are easing up and they can take advantage of them in areas like housing and things like that. Is that how business owners can really sort of, you mentioned they're staying adaptable and agile.
Yeah.
That's how they can do it, by
being
staying
aware,
close to those changes?
Looking for the new opportunities that exist out there because they're there, or because things have changed. As you say, the policy environment might have changed, or the economy might have changed in terms of presenting those new opportunities. And I guess we tend to, at the moment, focus a lot on this really big one, which is the sort of adoption of artificial intelligence to be able to streamline your business processes, find ways that you can make that engine, if it were, like if you think about like an engine to do the things that are currently being done that are more labor intensive or more, or you can find workarounds and so on. So, and we've got a lead to follow as well, because other countries are doing this too. The US is leading the way in terms of adoption of AI. So, we tend to be in Australia quite good at adopting technologies when they come along. We don't tend to be the one that invents the technology necessarily. We do invent some things, but in essence, what we're quite good at doing is being quite quick adopters. And so that's the thing we need to really, I think, focus on. I think businesses need to be thinking about how it is they can use this new sort of technology in the form of AI to streamline their processes. There's some surveys out there that ask businesses, small and medium-sized businesses, are they adopting AI? How much are they doing so? And at the moment, the surveys are still showing that only a small proportion of firms are saying they're doing it in a broad-based way. Some are saying they're thinking about doing it, and there's quite a lot. I think the surveys are sort of half the survey respondents at the moment are saying, well, I'm really not sure how I can do this. I'm not sure how I can make this work for me. And so that would be the part where you'd encourage businesses to go, well, actually have a look, find a way. Maybe this can actually do a lot for you that you're not aware of.
Okay, so being brave when it comes to tech adoption and being nimble and being aware of regulatory changes and changes in the economic environment. There are a couple of things. Anything else that you'd like to leave accounting and finance leaders with in terms of insights for planning for 2026, the rest of the year, and maybe the initial period next year?
I guess, for Australia, the challenge at the moment is inflation has reasserted itself. It's back as a challenge. We thought we'd sort of dealt with it last year, but it's not. It's still there. And I think that's the thing to watch out for. The RBA may very well have to lift interest rates a bit further yet to slow the economy down to deal with that inflation. So that's going to be one of the macro challenges that we need to keep in mind.
Sure.
At the same time, though, there are some signs that productivity is improving a bit, that there are some signs there, and there is certainly a more avid, I think, acknowledgement from policymakers that more needs to be done, both at a federal, state, local level to try to improve productivity. So finding the opportunities that's likely to bring would be the thing that I would most encourage, I think, businesses to be looking at.
Wonderful. I think, Paul, it's been a fascinating discussion, and one I think our members will get tremendous value from. Thanks for joining us today.
Thank you.
And for our listeners eager to learn more, check out the show notes for links to additional resources from CPA Australia. And don't forget to subscribe to In the Black and share this episode with your colleagues and friends in the business community. Until next time, thanks for listening.